Facebook's IPO started out with much excitement at hype, but the tone has quickly changed in the week following the company going public. The social network began trading May 18th at $38 per share, and after a jump to $45 a share, it closed at $38.27, just a few cents above its opening price. And the stock has dropped ever since after information came out that Facebook's underwriters lowered their earnings estimates during the public roadshow while only telling a handful of investors. And as a result, lawsuits have been filed against multiple underwriters, NASDAQ, Facebook, and even Mark Zuckerberg. And Congress is also planning to step in and review the issue. So how did this go so wrong, and what impact will it have on the social giant? Well, at this time, we're going to bring in Francis Gaskins, the president of IPO Desktop, to answer these questions and more. Thanks for joining us again, Francis.
Thank you.
You're welcome. Well, let's start with Facebook's first day of trading. When we spoke with you before, you told us that the projected valuation of $100 billion was too high. So were you surprised to see the stock price set to open at a price that valued the company at $104 billion?
No, I think that Mark Zuckerberg was going to have that valuation come hell or high water. I think he was kind of etched in stone, and so he may even have sandbagged the underwriters. He may even have given second quarter estimates that were too high because they had to come down. So I think he was talking a year ago about a $100 billion market valuation, and the financial numbers were a lot lower than he thought. They missed the estimates in December. I think they missed them in March, and then they came out, a couple of weeks ago, a week and a half ago, saying that they were going to miss their estimates in June. So, in a normal company with an IPO, that would have had more consideration in the IPO pricing. It would have been priced down a little bit, and they wouldn't have allowed the selling shareholders to just add $10 billion more in selling shareholders. When it was originally filed, February 1st, and we spoke shortly thereafter, that was for a $5 billion offering, all of the money going to shareholders. So it was since expanded where all the extra money was going to selling shareholders, and that's kind of a tip-off. That's a warning sign.
Well, do you consider Facebook's IPO to be a total failure?
Well, it depends on the audience. From the standpoint of the selling shareholders, it took out about $10 billion. It took $10 billion off the table, which, by the way, is more than the whole market cap of Zynga when it went public. From their standpoint, they sold at the top, and aren't they happy? From the sense of Morgan Stanley's reputation, that's not good. From the standpoint of the retail investors that thought there was a free lunch, that's not good.
So let's get into those issues. What really went wrong, and who do you think is to blame for this?
Well, all right. If you want to play the blame game, there's a couple obvious people that are at fault. And Mark Zuckerberg himself bears, I think, the brunt of it. And the reason is he allowed the company to put out projections for the second quarter that were too high. I think he put them out in, to justify his $100 billion market cap, and for them to come out so near the IPO and price and issue to Morgan Stanley a downward adjustment in the earnings is a super red flag. It makes you wonder, okay, they didn't know what's happening in the second quarter. How can they possibly know what's happening in the third quarter, or even the fourth quarter for that example? So a lot of risk, a lot of uncertainty in this stuff.
Well, do you think that the developments involving Facebook issuing more shares, like you mentioned earlier, and also GM pulling its paid advertising from Facebook, do you think that either of these incidents played a role in the current chaos?
Well, sure. There were a series of red flags, and those were two of them. The other one was that their mobile advertising, is not what they expected. And I think that's their Achilles heel. I don't think mobile advertising is ever going to be what they expected. They said, well, trust us, we're working on it. Well, I mean, mobile phones have been around for years, and they know the advertising. What really happened is that they were kind of sitting, fat, dumb, and happy with their desktop application with huge amounts of real estate, with all how they're going to generate increased revenue based on that. And then wham, the market changed quickly to mobile phones and caught them definitely flat-footed. So much for Mark Zuckerberg being a product genius.
Well, with this information that was shared to a select few, is it just unfair to these investors who weren't told, or were laws broken?
The investors that are irritated about that are I'm sorry. I mean, they're accountable. I mean, the IPO arena is you got to take your lumps. There's no free lunch. They were expecting a free lunch. And as far as the underwriters go, they always change their estimates. And what's wrong with that? That's the normal business. And they're certainly entitled to talk about it on the phone. What they didn't do is publish a research report. So in that area, what I say is there may be some harm, but no foul.
So you don't expect Congress to step in with any form of regulation or anything like that?
No, I think they're doing it just to raise money. All the Congress people do is sit around and raise money. That's what they do about 110% of the time. Wait, I didn't say it, but it's okay. So,
right.
and then you have the legal beagles. I mean, all the contingency lawyers do is they sue, and what they want is a settlement. And there's some big targets out there. Facebook is a big target, Nasdaq's a big target, Morgan Stanley's a big target. So the lawyers, they'll settle probably within 6 months, and it'll be blown away.
Well, you were skeptical from the very beginning. Do you, as a result of that, do you see these events as a shock at all?
No, it's kind of what I expected. I mean, what's really coming out is Zuckerberg, to me, instead of being a hero, he's a control freak that doesn't have any self-confidence. I mean, if he had self-confidence, he wouldn't have really made an effort to have 55% voting control. That means he's in no matter what. That means he's never ever accountable. As I said kind of before, Mark Zuckerberg, he doesn't know what he doesn't know, but who cares if he's worth billions of dollars? He'll never know it. He doesn't care. He's fine. And then after the disaster of the IPO, he left on a honeymoon. Catch me if you can. I mean, what's happening?
Right. Well, what impact do you think this incident will have on future IPOs, especially in the tech industry?
Well, I think it's going to make the underwriters look a little more carefully at the estimates. I mean, what's been happening, particularly in Facebook, is they just accepted the estimates, like puppets, and then regurgitated that to the investors. There's no value add there. They're going to have to add value and look at those estimates and think about the assumptions, and they have to be analytical about it. They just can't eat what's fed to them by people like Facebook.
So is it safe to say that Facebook's credibility is harmed by this?
Yeah, I mean, what's happened to Facebook is at one point in time, they had a lot of credibility. It was cool to be on Facebook. I think the result of this is the brand has been hurt, their image has been hurt. I don't think they know about handling a damaged brand and image. And what's funny is that now you can see jokes about Facebook. I mean, there's something on YouTube, if you look, called Zuckerberg Musical, a musical. So, I mean, if you're the butt of jokes, I'm sorry, I mean, that's not cool.
Right. Facebook's CFO, his name has been tossed around as said to take the fall for this. Do you think that he should at all?
That's not even close. Zuckerberg is the guy that controls him with very, very tight puppet strings.
All right. Well, there are rumors that suggest that Facebook is considering switching to the New York Stock Exchange. Do you think this will happen, and would it bring any benefits to Facebook?
Yeah, well, it could happen, and the reason is Facebook wants to say that it was all Nasdaq's fault, which it wasn't. I mean, and they want to say, "Oh, look, we're going to the New York Stock Exchange. Our slate is clean. Look at it as fresh. It's new." They can't do that. They can't wipe out history.
Well, do you have any advice for what Facebook can do to rebuild trust in itself?
That goes back a long way. With an egomaniac controlling 55%, that doesn't care, goes on a honeymoon. He doesn't care about enhancing shareholders' value. No.
All right. Well, what's your prediction for Facebook's trading for the rest of this year?
Well, I think, it came off the $43, $38 price, went down to $31, $32. It'll probably trade in this range for a while. Then I think the June quarter is going to come out, and they're going to say, whoa, it didn't quite happen, but trust us, here's what we're going to do in the future. But you can't trust them anymore based on their missing estimates this close. So I think as they have a kind of a second quarter that won't please investors, I think they'll have a third quarter that won't please investors. I think the price will go down quite a bit.
Well, we'll follow this closely. Thanks again for joining us, Francis. We appreciate it.
Thank you.
You're welcome. Reporting for WebPro News, I'm Abby Johnson.